an example in this standard of actually how to apply what they're asking us to do. So in this case, if we go into our notes and if we go into this problem that we're going to be working on, we're just going to use the same steps, and then we'll just sort of take our time on it to question if what we're doing is really making sense. So I believe now with inventory, we can do write-ups and write-downs as long as we say that they're reasonable. I will double check that for you just to make sure that I'm not telling you a fib. Okay, so this is the problem that we're going to spend the rest of the time on in class problem number 2. So I'm going to let you guys just take an opportunity to read through this, and then what I'm going to do is I'm just going to copy this information down into a new Excel spreadsheet for us to do. So you guys read through that while I put it into Excel. Okay, and then I'm going to do this cost and then retail. So I'm just taking the data out of the PDF. Oops, my number left on. And I'm just reproducing it here. Okay, so I think I got everything. So let me just see. So I just copied this stuff. And I actually put this stuff in the table too, the 20 and the 13,000 of the markdowns. So everything's just transposed onto my Excel spreadsheet. Okay, and the first one that I'm going to do is gross profit technique. And this will give us some good experience as well, trying to figure out what items we should put into inventory and which items we should just expense. So with any inventory account, and you'll especially learn this in management accounting as well, is they all flow very similar. You have opening amount, you have purchases, then you add those together, that's how much you have available to sell, and then you have your cost of goods sold, and then you have your ending inventory. So I'm just going to add some other things in here too. So I'll start with my dollar amounts at beginning inventory. I don't know how much units I have, so it's fine. I'm just going to do this on a total basis then. So I'm going to take my beginning inventory, add my purchases. But what happens if I purchase something and it's defective? Or if I purchase something and I pay it really quickly, so then the supplier gives me a discount. in those cases, what we can do is we can actually just decrease the value of our inventory, and then that will be factored into the cost per unit. So with my purchase discount, I can subtract that out of my inventory account, as well as anything that I return that is defective. Okay. There is a question though on transportation. So when someone's shipping goods to you, so the supplier is shipping goods to us, we can count that as part of the inventory cost. But if you go ahead and you ship something that you sold to a customer, so now you take it out, you're shipping something that was sold, then that's like, I guess I call it freight out. You wouldn't inventory that because we can inventory the stuff between the supplier and the company relationship. It's a different story when we're thinking of you and the customer. That's a different relationship. So you have to sort of segregate those costs and figure out which relationship those are going towards. So let's see, I have everything in here that I can possibly count. I'll do my column for cost of goods sold, and then I'm going to do my amount for ending inventory. So my problem right now is I don't know how much my cost of goods sold is. And because I don't know how much my cost of goods sold is, I don't know how much my inventory is. So what I can do is I'll just move over to the income statement. I'm not going to bother opening up T accounts for this. I'm just going to show it as if it showed up on the income statement. So I can take my sales, which is 1.5 million, and then the same thing. Customers return some stuff for whatever reason. So I would go ahead and subtract those returns from my gross sales, and then that'll give me my net sales. And then if I go ahead and subtract out my cost of goods sold, which is this number that's going out of inventory into cost of goods sold, that will give me my gross margin or gross profit. So I'm just going to say gross profit or gross margin because depending on which notes you look at, they'll use those terms interchangeably. So I have a problem here. Did they tell me what the gross margin dollar amount was in this question? Because if they don't, then sometimes they'll tell me what the percentage is. And when they do that, I'm assuming it's a percentage of net sales. So they will have to, in the question, either tell me what this percentage is or what the total dollar amount is. So I just want to know in the chat room. Okay, so they gave us this amount. They said that the margin was 52%. So that's pretty easy. So that means my cost of goods sold would be the difference, 48%. So let's just go ahead and work everything out. So if I take my 1.45, multiply that by 52%, that means my margin is 754. And then if I subtract that margin from my sales, that's my cost of goods sold number at 696. So working backwards, I know that that number is what came out of my inventory. And now working backwards again, I can just add up everything that went through inventory minus everything that came out of inventory. Voila. That's my final ending inventory number. So that's sort of fun. So I think maybe the biggest takeaway from here is because we're going to do the retail method as well, there's a lot of information in what was given to us that we didn't even really need to use. So again, when you're just thinking of inventory costs, you can even look through the standard too and see what they're pinpointing, but really I usually see beginning inventory, net purchases, freight in, cost of goods sold to give me my ending inventory. And this usually isn't too bad for me to do either because I know how to put an income statement together. So you're just working backwards. So do we have any questions on that one before I move to the retail method? Yeah, I would say markups and write-ups are the same thing. Okay, let's go through the retail method now. So we could use this method to estimate our ending inventory. Now we're just going to switch it to a different method. So I'm just going to copy this one. I should put this comparison right there. So I'm going to call this retail method. And I'm going to get rid of all of this. I'm just going to have the original information in here. Okay. And now what I'm going to do is I'm just going to, so what I've done is I have a blank Excel sheet now, so I don't have to keep creating them. So I have just a blank Excel sheet with a T account. So I can just copy and paste T accounts now. So here's what I'm going to do. I'm going to look at my inventory at cost. And then right beside it, I'm going to do my inventory at retail. So this would be at the sales price. And I guess the logic behind this is that you have all of the numbers at retail anyways. So then it's easy to use those prices in order to estimate your ending inventory at the end. So right now what I'm going to do, I'm going to move these down a bit just so there we go, is I'm going to start off with my beginning again. So I'm going to do the same thing I just did in the question before, and I'm just going to highlight this as I go. So for cost, my beginning inventory is $125. For retail, my beginning inventory is $280. So it's doing the same thing. One is doing it at cost and one is doing it at the retail amount. The next thing I want to look at is my purchase, or my purchases. So again, at cost, my purchases are $725. And at retail, my purchases are at $1.5 million. So I'm going to highlight those two. The next thing that I want to decrease my inventory items at is my purchase discount. So again, I'm just doing the same thing I just did in the last question under the gross profit method. So my discounts under cost are $5,000 and my discounts under retail are $0. Let's look at our purchase return. So I'm returning $10,000 just like I did in the last question. And under the retail method, my returns are 23,000.